Hey everybody, welcome back to Young Bucks. This week we're taking a look at the German election results. We'll also dig into Trump's tax plan as well as the 219% tariff on Bombardier. And we'll also discuss how corporate mergers and acquisitions affect consumers. Thanks for joining us.
Hi everybody, welcome to What the Buck, the segment where we talk about money, but really just talk about college football and make stupid jokes. Today we're going to be talking a little bit about the German election from last weekend, which was a surprise. We're going to be talking about the new Google phone. We're going to be obviously hitting college football picks, and then we also have a little bit on the Trump tax plan. I'm Andrew Hall, joined here today by Sam Frost and Matt Krebsbach. So let's just kick it off with Germany. So far right gets 13% of the vote, which would seem small by our election, but because they use coalition governments, it's actually quite a significant amount. Far left loses. And importantly, Merkel, who has the leading coalition, she got down to 32.9% of the vote from previous 41.5%. So is this the end of Germany, or is it the beginning of the Fourth Reich?
Is it the beginning of the Fourth Reich? No, but I think it's a good start of what you're going to see eventually. I think the EU is going to break up. I think it's just a matter of time before that happens, whether it's 5 years, 10 years, 20 years. I think that's kind of like the consensus that at this point, like, it's not too far out of an opinion, but I think you're seeing the starting points of that.
So you say the EU
as a whole,
could break up. Is that because of the Brexit from last year?
I don't think the EU is like really beneficial to Germany because they can keep their currency low. Because Germany's like the big dog on the campus in the EU, and they have like all the trashy like Greece companies keeping their currency flat so they can have good trade balances. Yeah, but I think it's even with that being the case, I think it's only a matter of time before it dissolves.
Yeah, and it's interesting because Germany is like the main beneficiary of the EU. And so if all of a sudden the EU's starting to, if Germany's starting to kind of be on the rocks, people are kind of changing the way they feel and stuff, like all of a sudden like that centerpiece holding the EU together, weakens a little bit, it could be. But that's something that's going to take, Brexit, they're still talking about taking 2 full years for it to even play out. So that's a long time in the making. I don't think that's something to worry about right now.
The thing about coalition governments and the way the parliamentary system is organized is that it really makes progress very slow. And you think that progress in the United States is slow? When an executive decision has to be made by 3 different parties in order to do anything, that's going to be very slow, which is why you didn't see even the UK, it only withdrew from the EU because they had a referendum on it. Parliament never actually got anything done on it. So when we talk about the far-right groups winning, it's worth bearing in mind that the National Socialists were doing very well in Greece just a few years ago, and there was a lot of concern about that and consternation about that. But that ended up kind of washing away, and it wasn't as hardline as people thought. So bear that in mind when you're talking about European elections and far the investment consequences. But I agree with you, Matt. The likelihood for the EU really staying together as it is right now seems very unlikely. The Articles of Confederation lasted in the United States for about 10 years. So next up, what do we have next? We have the Trump tax plan. So he's talking about as far low as 12% rates for some people. But Bloomberg, we have a headline here that says, leads off the article saying, President and Republican leaders inch closer to releasing their tax framework this week as details leaked to lobbyists suggested it would dramatically cut taxes for corporations and the wealthy, provide a measure of middle-class tax relief, and punish some households in Democratic-leaning states like New York and New Jersey. So Trump is going to punish the poor people and help the rich people. What else is new in American politics? Greg, do you have anything to say on that?
If you get into the details of what that article is talking about, there's a ton of aspects in there included, like in regards to the tax code that he's proposing changes to. Obviously, this is like crucial to Trump, in my opinion, because really what he said he's trying to do when he ran for president hasn't happened. Like healthcare, nothing's really happened there. the travel ban that hasn't really fully gone through like he wanted to. So now you're getting to the tax plan, which is something that he can hang his hat on with his entire presidency if it goes the way he wants it to. But in terms of like all the like little details in the tax plan, like doubling the standard deduction, and I think he wants to take out estate taxes, all of that's not going to go through. Like even targeting 35 down to 20, I mean, it's probably going to go down like 5 or 10%, I would guess, at most. He's going to have to make concessions.
So Trump not hanging his America Great Again hat on anything anytime soon. Sam, you have any thoughts?
Yeah, one of the things that I thought was interesting was talking about the corporate tax rate, dropping from 35%, and that saw some talk about the top tax brackets. So I was like looking into it because I was curious. I've never really looked. The top tax bracket for married filing joint households is 39.6% if you're making $470,700 a year or more. How in the world does somebody making, call it $500,000 a year tax more than corporations who are making, billions of dollars a year? Mm-hmm. And so it seems silly that that's the case.
Well, the corporations would say that they're already taxed through dividends, and their shareholders are already taxed because dividends are taxed.
Well, whatever it is, it just seems silly to keep that seems backwards. If anything, drop the individual tax bracket below it, and then I don't know, bring it all down.
One other thing I want to add on this, I think another big detail in that tax plan is repatriation for all the companies from their overseas cash. I mean, that's a one-time repatriation, and that's a ton of, that's billions, borderline almost trillions of dollars that would just be, in terms of the stock market, that's an incredible amount of buybacks and reinvestment in CapEx, people, whatever it is. I think the better way to do that would just fix it so you can have like a permanent lower tax rate on that cash. Like, it doesn't make sense to have a one-time relief and then go back to what it was before. I don't know, that doesn't make sense to me.
I agree with that. It's like giving everyone $100,000. What would happen? Everyone would go out, buy a nice sports car, and then there it is. And then
in 5 years you'd be asking for another $100,000 or whatever.
And then you have a recession because the comp period would be so much harder.
So, and I guess the argument for that though is that if times were tough and you give everyone $100,000, that they would save that money, but they'd want you to spend it, right?
I think that example is a little flawed because this is only like 20 companies that are going to wait that money. It's not everyone.
Yeah, Apple would build some huge, obnoxious campus in the middle of San Francisco or something. So actually, speaking of Apple, let's talk a little bit about Google.
That was a great segue.
And the Pixel 2 phone, which they're about to launch. We're all iPhone users. We have a couple Google users, Android users in the office, but iPhone is very much the predominant device. Do you see yourself buying this new Pixel phone, and what do you think about it vis-a-vis the iPhone X?
I would honestly consider it. I think the basic Pixel 2 with 32 gigs, correct me if I'm wrong on any of this, but is going for like $650 compared to whatever the 8 is going to be, like $1,000, or is that the X?
The 8's going to be $699.
So
okay, that kind of defeats what I was going to say.
The X is going to be $1,000.
Okay.
And the 9 is going to be $0 because it doesn't exist.
I will say that the specs of the Pixel haven't been out yet. Like, I don't know how good the processors are and stuff like that. Like, I don't know how good of a phone you're actually getting for that money. But I guess overall what I'm trying to say is I'm definitely going to consider it.
So to let you know how much I'll consider it, I had no idea what y'all were talking about when you said Google's Pixel 2. So,
Sam's out.
I'm curious, do either of you two in the studio, have y'all heard of the Pixel 2 Google phone before? 1, 2. All right, maybe I'm the only one who hasn't.
So,
what about you? Are you going to consider?
No, I'm not considering it. What I am considering is college football picks, so let's get to that. Krebs, lead us off with the Badgers.
Well, I'm just going to start with the current places, so we got that in order. I'm currently in first place at 13-4. Ben and Andrew, who's not here, are 12-5, and Sam and intern Garrett, are 11-6. First game this week, Wisconsin minus 15 at home against Northwestern. I think Wisconsin's got that in the bag.
In the bag.
Northwestern got smashed by Duke, and I don't think Duke's as good this year as they were before. So I
Sam,
think
what do
Wisconsin's going to start their conference season strong.
I'm taking the Badgers.
Yeah, so I'm taking Badgers.
Man, this is really tough. I think Northwestern is terrible, but I also think the whole of the Big Ten is terrible because the SEC is the best conference. I am taking Wisconsin in that, though, to cover because Northwestern is so bad. I think Wisconsin's bad, but it's going to be about 15-0. It's going to be about maybe 16-0. They get a safety, two touchdowns, and let in 0 points. So next one is
I got this.
okay.
I'll do this part. All right. Next game is Georgia -8 at Tennessee. Usually Andrew does this analysis, but Ben wants to take it.
Andrew, take it.
Yeah, Andrew will take this one. Georgia, I mean, they just had a great win. I kind of predicted it. I said they were going to beat Mississippi State. I really didn't think that Mississippi State was that good. Georgia,
Their alumni base is just so weak too.
and the thing we're doing in Georgia is that we are winning without our starting quarterback. People say, "Oh, Fromm's very good," but there was a reason he was second string. And we're still beating Notre Dame. We go to Notre Dame. We beat Mississippi State, who's supposed to be a great team, at home. And now we're going to go to Tennessee, and Tennessee doesn't have anything. They lost Dobbs. Whenever you go to the Tennessee Stadium, it's probably worth 3 or 4 points. Some people say 7. I think it's about 3 or 4. But I'm taking Georgia in this to cover the 8-point spread.
Tennessee.
I think Tennessee's going to be really hyped. I mean, they already lost to Florida. They're not that good this year. Obviously, they've barely beat bad teams, but I think they realize if they want a chance at doing anything, they have to win this game. So I'm taking Tennessee. Next one, Washington University -27 at Oregon State.
I don't know what Washington University is, but University of Washington is actually playing Oregon State, not Oregon. But I think they're going to cover. They had a really good outing against Colorado, who is supposed to be a great team from the South. Their quarterback looked really rough. We really roughed him up. And I think Washington's the class of the Pac-12 for the second year running. They're going to cover the spread easily. If you're betting on Oregon State, watch out because you're about to get annihilated in the first quarter.
I got Oregon State.
I actually took Washington. I think, like Ben said, Oregon State's really bad.
That's a huge spread.
Colorado's really bad too, but I think Oregon's even worse. Oregon State's even worse.
Yeah, SEC is definitely the best conference.
Sam, this one's you. Alabama -28 at home against Ole Miss.
Yeah, that's a huge spread for me. I know Alabama just slaughtered Vanderbilt, but they've struggled with Ole Miss the past 3 years. Lost 2 in a row, and then they barely won last year. I know Ole Miss is having problems with new coaches and a bunch of stuff going on, but Ole Miss is going to be pumped out there and come out there fighting, and that's a huge spread. So I'm going to take Ole Miss.
That's great analysis. I agree. I took Ole Miss.
I'm taking Alabama. Ole Miss is just bad. Vanderbilt is really bad. This is what happens every season. Everyone gets all hyped up on Mississippi State or Vanderbilt and Tennessee, and they always just tumble at the end. And I think that's the same as going to go for Ole Miss. Alabama's going to cover the spread. It's just a machine that Saban's got going there.
And the bonus game of the week. This one's on Friday, actually. Kind of unique dynamic there. USC -4 at Washington State.
I'm taking Washington State. They're going to Pullman. Pullman is a tough place. It's tough. It's out there in eastern Washington. You think of Washington, you think of the trees, but it's the desert. And so watch out for those tumbleweeds. All those Southern Californians have never seen that before. Sam Darnold hasn't seen that. He's going to be shocked what he sees in the Blues. So I'm taking Washington State.
I got USC.
I think Washington State's one of the chronic overhyped teams early in the season, and they always drop the ball, so I'm taking USC.
Yeah, USC is definitely never overhyped. That's it for What the Buck. I'm Andrew Hall. This is Matt Krebsbach, Sam Frost. Stay tuned for the rest of the show. Everybody, welcome to Tanked, the part of the show where we educate you on some things that you might be hearing in the news media and the financial news, or things that are just so commonplace that everyone thinks that you should know, but none of us actually do know it. So today we're going to be talking about interest rates, and specifically what it means when the Fed raises rates, because when the Fed meets, which is every 6 weeks, they have to make a decision on whether or not to raise, lower, or maintain the interest rate. So we want to discuss, what is that interest rate? What is an interest rate? and what is it? What are the consequences of that? So Sam, let's just start off. What is an interest rate?
Yeah, so interest rate is simply just how much I need to receive in terms of to incentivize me to lend money out. So if somebody says, "Hey man, can I borrow $100?" Then I'm gonna require, depending on how long you hold that $100 before you pay me back, I'm gonna require you to pay me some amount to incentivize me to forego that $100 for however long the loan lasts.
That's like a 5%, a 6%, right. Something like that. So you have interest rates on your house, you have interest rates on furniture, you have interest rates on credit cards. What you don't have is interest rates at your local car dealership, where you can have zero money down, 0% interest rates for the next 72 months. No, we're being facetious, but you end up having an interest rate. Mm-hmm. So lower interest rates are best if you're borrowing money. Higher interest rates are good if you're lending money or you're saving or investing. So that's what an interest rate is. It's the money that is paid for the right to essentially use money that is not yours.
Yep.
So the next thing that we want to talk about is, what is the Federal Reserve rate? Because that's a little bit different. And I'll just start off. The Federal Reserve rate is not the rate that you pay on your house. It's not the rate you pay on your car. It's not the rate you pay on your credit card. It's the rate the Federal Reserve targets, which is an institution put in place by Congress, and it's the rate that this organization targets for banks to lend to essentially one another. And what this means is that it basically sets the baseline of what is the lowest interest rate there can be. And the Federal Reserve does this for a number of reasons. Why would they lower interest rates?
Yeah, so one of the reasons that they're going to lower interest rates is to incentivize people to spend money. And so that's why you see it in recessions all the time. You see it like right now, we're coming out of the 2008 recession over the last 8 years, and they're talking about raising interest rates. When the financial crisis happened, they slashed interest rates, trying to incentivize people to go out and spend money, invest, hire people. And so what happens with the low interest rates, you're not incentivized to save money because you're not gaining anything from it.
So if it was 2006, mm-hmm. and I could go to the bank and get 5% on my money just for putting it in the bank, I'm probably going to take that option rather than going out and trying to build a business mm-hmm. and employ people,
right,
or buy a house or something like that. But when they lower rates to like 1%, then all of a sudden, like, man, money is so cheap. They call it cheap money, which basically means that you don't get much for saving, so you might as well invest. Some people will argue that it incurred malinvestment, which means investment was overdone, overheated. That has not been proven out yet, but that is a concern when the Fed lowers interest rates so dramatically.
Mm-hmm. And then another reason that the Fed messes with interest rates is to try to manage inflation and keep prices steady. That's their biggest goal is price stability and maintaining full employment, or what do they call it? The
maximum employment.
Maximum employment. There's like a certain level that they view as being optimal. And so they're trying to manage that. And so as they raise interest rates, inflation drops. And as they lower interest rate, inflation rises because they're inversely related. Yeah, and so Ben, you can elaborate more on the financial crisis in this situation.
Yeah, so this is a great case study in how the Fed operates in terms of what it actually does in order to have real impacts on the economy. And so what you saw in 2008 is that you saw this massively low inflation, which means prices were falling. Just think of the value of your house. Your house value, unfortunately, fell. Wages did not do well because there was a ton of unemployment. So what the Federal Reserve did was they lowered interest rates dramatically, encouraged people to invest their money, and that investment increased employment and started to stabilize prices. So now what we've seen about 10 years later now is that inflation has not been excessive. It's still been actually fairly low, but it's stabilized a little bit more. And employment has dramatically improved. We're now at a 4 to 5% unemployment rate for the country overall. And so the Federal Reserve is now saying, okay, we're at a more normal time, so we're going to start slowly to raise interest rates. normalized policy. The Federal Reserve works best when it's under abnormal conditions. You don't want a lot of central bank manipulation under normal conditions because that can skew things. They need to operate when things get bad because they are the lender of last resort.
Mm-hmm.
Now, what can we expect from the Federal Reserve through the remainder of this year and going forward?
Yeah, so like you said, inflation has begun to stabilize, and so the Fed is slowly trying to raise rates. And something that we haven't mentioned is that it's using interest rates as a means of trying to get the country in and not in, but out of recessions. Interest rates is an effective thing, as we talked about. Cutting rates helps spur employment, investment, and growth again. So after we've had, a couple quarters of decreasing GDP, we need to be able to, ideally we can still cut interest rates to spur that growth again. And so right now with super low interest rates, they're now in the 1 to 1.25% rate range. If we were to slip into recession overnight, we don't have far to go. We can't lower rates that much farther before we start messing with the zero bound, and whether we decide to actually go negative or not. And so for that reason, I think the Fed is, you keep seeing more and more uncertainty, just especially in DC, and geopolitical uncertainty around the world. I think the Fed would like to raise rates to help themselves have that tool to, spur economic growth should we need it. So they have 2 meetings left. They kept rates steady at this last meeting. If I had to guess, I would say one more rate increase for this year.
Yeah, that's what I would say too. I say they raise in December, similar to what they did last year.
Yep.
And then I think that we probably get 2 or 3 more rate rises next year as well.
Mm-hmm.
So we could be up to 2% on interest rates, which are still very low
Right.
if you look at 2005 levels. Now, this does not mean that you have to go or rush out and buy a house right now because this is the very low level of interest rates. This is not what you cannot buy a house by borrowing at 1%. That would be awesome if you could, but that doesn't happen. So while those are correlated with the rate that you would pay on your mortgage, they are not as correlated as you might think. So I think that the Fed raising rates is a reflection of a stronger economy. This is good news, not bad news. And I would look for a continuation through the end of 2017 and into 2018.
Yeah, and so Ben, the last thing I wanted to mention was the real effect that you would see as a personal consumer, taking out loans and stuff for, cars, houses, whatever, is if you do a floating rate interest rate. And so it would be tied to, not tied necessarily to this rate, but it's kind of a benchmark. And so if you're playing, some benchmark plus 4%, whatever, you could see it rise with this by, 25 bips,
Yes.
every quarter-ish.
That's a
something
very
like that.
good point. Watch out for those floating rate loans in a rising rate environment. If you're borrowing money, fixed is the way that you know what you'll actually end up paying.
Yep. That's it for Tank. Enjoy the rest of the show. Hey everybody, welcome back. This is Sam and Matt Krebsbach here to talk about a little M&A. So a couple of weeks ago, we talked about M&A from the shareholder side and if it's good for shareholders. This week, a couple of days ago, John Oliver did a thing on M&A being bad for consumers, and so we thought we would discuss this as well. So Krebs, 1,000-foot view, what do you think? Good or bad for consumers?
I don't think you can take a black and white approach to it. Like, ideally, they should be good, but let's be realistic. They're not always going to be good. Like I said, you have to be realistic. One of the main things that he talked about was the airlines, and obviously there's been enormous consolidation over the past couple of years. I think you're down to 4 majors there, but I mean, if you look at just average airfare in the past 10 years, in 2016 it was the lowest it's ever been in that time period. Obviously, a lot of it's due to gas prices, oil prices, but I mean, for the most part, I think you just can't put it all in one bucket,
Right. And so
they're not coalescing together and saying let's jack up these prices. It's
Right.
possible, but
it's possible, but
regulation shouldn't allow that.
It almost seems like the opposite's happening, and that prices are coming down. And like you said, a lot of that is due to oil. But another example would be telecom, right? So that's another oligopoly. We have 4 main competitors.
Soon to be 3, ironically
Soon
enough.
to be 3.
With Sprint and T-Mobile trying to merge.
Right, and those prices just keep coming down, and people are talking. You see the ads for T-Mobile talking about, or is it Sprint? I don't know. One of them cutting your bill in half and stuff like that.
I think T-Mobile is trying to offer free Netflix, and I think AT&T is now offering free HBO.
Right. And so we often talk about, the race to zero in the telecom space. But I mean, you're right. M&A could be bad for consumers in that, in those two scenarios, the prices are coming down, but the opposite very well could happen if you have less.
Like in the airline issues, I remember a couple of years ago, like there was like serious like regulatory issues of, I can't remember who it was. Let's say United American, like getting together and saying, "Hey, let's juice up these prices for Christmas weekend."
Right.
Like that's a really big issue.
Right. And that's definitely a good point, is that they can collude together. If they wanted, they could jack up prices. You have less people out there fighting, trying to be the low price guy or whatever, less price warfare initiatives, I guess.
I think part of it is just that's how capitalism works. He also talked about the beer industry and like how Molson Coors, Miller Lite, Coors Light, and Anheuser-Busch own like, I can't remember what it is, 70% of the U.S. beer market. I mean, the amount of capital that you need to, one, do the marketing and the distribution, there's just like enormous, and it's not possible for a smaller brewer to do that even. Like, it's just economics,
Right.
It's just how the market is.
Right.
And one more point about the beer industry. I mean, one way to benefit in any industry, one way to benefit from that, if you think you're getting screwed over there, I mean, just buy the stock in the company. You're going to benefit.
Right.
You're going to benefit as a shareholder.
Right. And so there's a lot of good points on why the consumers have benefited, theoretically, and I'm sure there are examples out there where the consumers do get screwed. And one of the situations I think of is right now a big acquisition in the process, or in the making, is the AT&T and Time Warner acquisition. And so right now it's trying to get through regulations, and some of the big concerns is like the net neutrality stuff. And so now all of a sudden you got an internet provider who now has access to content and becoming a content, they're going to deliver the content. And so you could have a situation where they say, all right, you love HBO, you love Game of Thrones, you only get to watch it if you're on AT&T's platform, which would not be good for consumers. And then,
I wouldn't be happy because I don't have AT&T.
Right. And so then all of a sudden everyone who's on Verizon or whatever is going to make a decision like, how bad do I want to watch Game of Thrones? I'm not sure that AT&T would be allowed to do that, but the net neutrality thing would say, okay, AT&T says everyone can pay for HBO, but if you watch it through AT&T's platform, you get full speed. If you're watching it through Verizon's network or T-Mobile's network or somebody else, they give it to you at like a slower speed, and so it's glitchy, it's harder to watch, not as fun to watch, and to try to incentivize people to jump over to AT&T. And so that would be an example, and which I don't think will happen. I mean,
Can't rule it out.
Can't rule it out, but that's definitely something that people have been talking about. So there you have it. M&A, some good, some bad for consumers, some good, some bad for shareholders. If you don't remember, check out a couple weeks ago's episode. See you next time.
Hi, I'm Ben Nye. Sometimes on this segment, we take an irreverent approach to our conversations about bad actors in our industry. But today, I want to talk about something that's actually very serious. The announcement yesterday from the Trump administration, coming from the U.S. Department of Commerce, was appalling, uncalled for, and very much regrettable. Bombardier, the Quebec engine manufacturer, they make a lot of engines for and planes for the commercial space. They also make Learjet. They also have a large business in trains, has been slapped with a 219.63% import duty by the Trump administration, which means if you are an American airline like Delta, United, or American, or Southwest, and you want to purchase a Bombardier plane for, say, $25 million, you're no longer going to be able to buy that plane for $25 million. You're going to have to pay somewhere in the order of $75, $85 million for that plane that only costs $25 million. Yes, $50 to $60 million of that would go to the U.S. federal government. So why did the Trump administration do this? Bombardier was run to the edge of bankruptcy by its CEO. This was really bad. He was totally in the business for himself, not for his employees, not for his customers, not for his shareholders. He's gone, and they brought in a new management team. The Canadian government helped bail the company out. Now they're on this path. They have a new jet called a C-Series, which they're just in the process of ramping up. Now, when you ramp up a new jet, one of the key things is you have to build up that volume because it's actually cheaper per unit to produce many planes rather than a few planes. So what you'll do is you want to get those contracts. So you're going to bid a low price for something and potentially underbid the market because you need to get that volume up. So that's what Bombardier did. They won a big contract with Delta, and now they're really ramping up the production schedule of these jets. And they perhaps have saved the company. The problem is when Boeing found out about this. Now, Boeing did not bid on this Delta contract. Boeing wasn't even in the contest. Boeing is now whining and complaining that Bombardier is dumping planes into the U.S. market, which are subsidized by the Canadian government. Now, you can make an argument that this is true. However, you also have to make the argument that Boeing was materially harmed by this. Boeing did not even bid on this contract, but they want Bombardier gone because they don't want to have to compete in the future against this jet. So what Boeing does is that they go to the Trump administration and start to whine. And they whine and they whine and they whine. And so Trump comes out with his Commerce Secretary, Wilbur Ross, and slaps a 220% import duty on this. Bombardier is a huge employer in Quebec. Bombardier employs a lot of people in Northern Ireland. No one there is happy about this. And what you have to understand is that this is not unprecedented for a government entity to bail out a large manufacturing company in order for that manufacturing company to survive and compete on the world stage. Trump needs to think what would happen if Canada reciprocated or China reciprocated. Because if China reciprocated, GM is not selling any cars there because remember, we bailed out GM. Bank of America is not doing any business outside the United States. Neither is Citigroup. You have to think about the consequences of your actions. This isn't fair trade. And bear in mind, Boeing pays an effective tax rate of 12% in 2016. Are you telling me that's not a subsidy when the corporate tax rate is 35%? Boeing is being subsidized as well. I would like to see what the new Air Force One has added in order for Trump to be happy and make this deal. I bet it looks really comfortable on the inside. And Wilbur Ross. So Wilbur Ross was the Commerce Secretary. He actually put in this order. He specialized in distressed investing. What he would do is buy companies that are on the brink of bankruptcy, restructure the company, take away people's pensions, restructure it, roll them up with other things. He did this with the steel companies in the early 2000s. What happened then, he rolled them up and then sold them to an Indian company. That's not friendly to the employees. And he's not that great of an investor. I mean, he's done well for himself, but for investors, it hasn't been so great. He started a blank check company called Wilbur Ross Holding Company that bought the firm Nexio Solutions, which was a private company at the time, owned by private equity company TPG. And Wilbur Ross, what he did, he bought the company and essentially took it public through this blank check company. Since that time, the stock price has dropped from $10 and it was trading at $7.32 when I checked this morning. That's a decline of 26%. So what I would say is, Wilbur Ross, use your common sense, because while slapping these import tariffs may make you feel good about yourself in the short term, the long-term consequences are potentially extremely bad, not only for Canada, not only for employees, but also assuming retaliation and the U.S. businesses that would suffer as a result.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.